Good morning, everyone, and welcome to the Graham Company's webinar on the impact of the hard market on claims handling. I'm Pete Princeton, Senior Vice President and General Counsel with the Graham Company. My co-presenter today is Krista Soffinelli, Associate General Counsel at the Graham Company. We spend the vast majority of our time helping our clients in claims situations. And what we've seen over the past few months is a significant change in how insurance carriers are handling claims. It is noticeable that they are being far more meticulous on the application of certain conditions in the policy. We'll review those conditions today. And you might ask yourself, well, why is that? I mean, the reason is that they no longer feel the need to say not to be nice. And right now, insurance carriers are significantly increasing premiums in this hard market, increasing deductibles, things like that, which means that programs are getting marketed far more significantly in this hard market. And so they're not looking for clients anymore. Clients are coming to them. And so what we found as a result of that is that insurance carriers now are more than ever looking for ways to deny claims. So what are we seeing? We're seeing that insurance companies are becoming far more, as I said, meticulous in dealing with how insureds, policyholders, comply with certain specific terms of the policy. And you'll note on this slide that we're going to talk about 9 specific items in the policy where we're starting to see a movement away from being nice and a movement toward total required compliance. Those 9 items are the notice requirements, and that is the notice where you're initially telling the insurance company that you have a claim. Cooperation requirements, where you're obligated to give statements, to do nothing that is going to impede the insurance company's rights. Consent provisions, where the insurance carrier has the right to consent, for example, in settlement offers. Allocation provisions, where there might be some covered claims, some uncovered claims. And that's always an issue with how those claims get paid and how much is allocated to which part of the claim. Hammer clauses. Hammer clauses are provisions that hopefully are not in your policy, but under some programs, you can't get away from them. They set the policy limit at a number where the plaintiff making a claim against you is saying that I'll settle, for example, for $100,000, and the insurance company says, we want to pay the $100,000, and you have a consent to settle provision, and you say, I'm not going to pay it. I don't want to settle for $100,000. And that means the hammer clause, if fully applied, and it's 100% hammer clause, drops the limit down. Previously, it was always a negotiation. Things are looking a little bit different. Selection of counsel, suit limitation periods, the length of time within which you can sue the insurance carrier, related claims provisions, and facts and circumstances reporting. So with that, I'm going to turn it over to Krista.
Hi, good morning, everyone. One of the first things that Pete mentioned was the notice requirement in a policy. Now, this is triggered depending on whether it's an occurrence policy by the occurrence of an event, or if it's a claims-made policy when the claim is made to you as the insured. Most of the language in occurrence-based policies uses that terminology as soon as practicable, but there are some noteworthy exemptions the cyber program, which is notoriously difficult and uses terms like immediately, and that's immediately upon your notice of an event happening. So if you know that someone has intruded into your system and potentially compromised some of your data or your client's data, that notice has to occur to the carrier as soon as you know about it. And that's for good reasons and some other reasons we'll talk about in a minute. Pollution also has some stringent requirements, especially with respect to cleanup expenses. So if you have some sort of release of a pollutant that needs to be remedied, you are required to notify that carrier in some cases in 24 hours. So it's very important that you do so as soon as you know about it. The burden is always on the insured to demonstrate that you've complied with these provisions. And you might say to yourself, well, if I'm a little bit late and the insurance carrier, we're in substantially the same position, they shouldn't be able to deny me coverage because I failed to notify them timely. But there are not a lot of states that require the insurance carrier to show that they were prejudiced by the failure for the insured to comply with this provision. So as soon as you know about it, let your broker know about it, who can help you let the carrier know about it. Then the next thing we'll talk about is cooperation. There's always terms and policies. Chelsea, just to the next slide. Thanks so much. There's always terms and policies, provisions and policies that require the insured to cooperate with the carrier. This duty will extend to supplying the carrier with information, with documentation that they might require, to the extent that they need you to testify in defense of the claim, you're required to do that. And then there's always this general thought that, or provision that says that you won't do anything to otherwise compromise the defense of the claim or put the carrier in an adverse position to defend the claim. You'll notice on the slide, it talks about notifying law enforcement. That's overwhelmingly with respect to crime policies. There's a duty to notify and to file police reports in the event of a crime claim. One thing we put here about approval of expenses could arguably have gone on the next slide that talks about consent provisions and payments clauses. This we wanted to make a special note of because for some policies, cyber being one of them, pollution being one of them, and a segment of contractors' professional policies that talk about rectification coverage, you have to notify the carrier and request their approval before you start incurring expenses. This often happens, in those cyber and pollution incidents where something happens and you need to respond very quickly. So, you have an intrusion into your system and you want to be able to shut it down and put your system back up or recreate your system. Before you go and incur those expenses, which can be very, very costly, we need to make sure we put the carrier on notice, because what is happening is if you do incur those expenses for things that they didn't approve or for vendors even that they don't have pre-approval of, they will deny a reimbursement of those expenses, which again can be very costly. So as soon as you know about it, let us know and let the carrier know. On the next slide, we talk about consent provisions, and this is also known as the one back, Chelsea. This is known as the voluntary payments clause. This exists in all forms of insurance policies. The provision in here that we have is one of the most often used in policies. This provision really is there so that you give the opportunity for the insurance carrier to investigate the claim, participate in the settlement. If you violate this claim, it really deprives the carrier of the choice in settling the claim or continuing to litigate it. And violations of this, will result in a lack of coverage, and we're seeing carriers be more strict about that. And, again, as we saw in the notice provision, there won't be a requirement for most jurisdictions for the carrier to prove that they were prejudiced in this instance. So for example, if you have a dispute with a customer that would otherwise have been covered by an insurance policy, and in order to sort of mend that relationship and continue to have goodwill with the customer, you decide to make a payment or disperse some money in some fashion to sort of mend the fence. And then you come back to the carrier and say, well, here's what we've done, please cut us a check for that money. That's overwhelmingly never going to work for carriers. They want to be there every step of the way, agreeing with the strategy and agreeing with the amount that you've agreed to settle the claim for. So be very wary of those provisions in the sense that you need to loop in the carrier, and we can help do that and facilitate that. The next slide talks about allocation, which Pete briefly spoke about. This occurs when we have a lawsuit and there might be some claims which will be covered by a policy and other claims which won't be covered by a policy. It can also happen when a plaintiff sues defendants who are insured under the program and others who won't qualify as insureds. Not all provisions here are alike. We try to get allocation provisions which allocate 100% of defense costs to covered claims, even though uncovered claims might also be present in the lawsuit. When you start talking about settlements of claims and the indemnity, that's when you start to talk about having to allocate between what is the most exposure to the client. So, if you get to a situation where we're in the midst of trying to settle or negotiate a settlement for a claim where there are covered and uncovered claims, there's going to have to be that dialogue with the carrier about what represents the most exposure to them, or to the insured rather. Is it the claims that are covered by the policy or the claims that aren't? And that's a dialogue that is something that should be undertaken with consultation of defense counsel and your broker. You want to make very sure that nothing you do in the defense strategy puts you in an adverse position. So, working with counsel to discuss when they're writing opinions about the case and the relative exposure of the claims to the insured, making sure that that puts you in the best light vis-a-vis the covered claims. And similarly, making sure that, dispositive motions that would kick out some claims in the litigation aren't only those covered claims, because then again, it puts you in an adverse position from a defense standpoint. We're going to go to the next slide. We'll talk about something called the hammer clause, which Pete again alluded to. These are usually present in professional policies and D&O policies. Essentially, it gives the insured the right to consent or withhold their consent from a proposed settlement agreement. Where the insured disagrees with the settlement and says, no, I don't want to settle there, if in the insurance carrier's estimation that withholding was unreasonable, then they will invoke this clause. And we're seeing this more and more, pressuring clients to settle claims that maybe there's some initial disagreement about. If they invoke the clause, any settlement beyond the amount of the settlement proposed would be bore by the insured. Now, there are instances where, like we try to remove the hammer clause from all policies. Sometimes that's not possible to get a total removal. We might allocate and negotiate what's called a soft hammer clause, which allows you to have a specific percentage allocated such that if there's a settlement beyond the proposed amount that the insured disagreed with, that percentage, say you are able to negotiate 70-30, such that any settlement above the proposed settlement amount, 70% would be paid for by the carrier and 30% would be the responsibility of the insured. Again, in the hard market, we can mostly sometimes get that removed, but we're seeing more and more in the claims scenario where that is being invoked or threatened to be invoked when there's a disagreement about whether or not a settlement proposed is the right course of action. And on the next slide, selection of counsel. This is always a very hot topic for clients, and we completely understand why. Your businesses and financial exposures on the line, and you want to be able to select somebody who you're most comfortable with, knows your operations. And we're very cognizant of that. We work very hard with insureds to, if they have such a counsel already in mind, before the policy is bound and before the payment of premium is made, we like to get those counsels specifically endorsed on a policy. Really, that's the only way to ensure that the carrier will allow us to use your preferred choice of counsel in the event litigation happens that the policy would respond to. Mostly we're able to negotiate that in professional policies, some D&O policies. Professional, the thought process is there that your reputation is at stake, and so you should be able to more control who is your selected counsel. It's also, we're also able to get that endorsement and get that consent from the carrier when you're a larger account with a higher SIR or high deductible, and you have more, quote, skin in the game. Now we are seeing in the hard market carriers being more insistent that they use panel counsel, the insureds use panel counsel to drive down costs, because statistically speaking, panel counsel are usually at a lower rate than most insured's choice counsel. So you just be cognizant of that. The more you can negotiate before a policy is bound, the more likely that we will be able to secure that choice. Just be aware that this issue is out there, so more dialogue that you have with your broker before renewal is better in that scenario. And so we'll move on to Pete, who's going to take the next slide.
Yeah, the next slide deals with a topic, suit limitation periods. This is the amount of time within which an insured has the right to sue the insurance company who has denied all or part of their claim. If there were no suit limitation period in the policy, then the suit limitation period defaults to the actual statutory or case law language for the particular state in which the claim occurred or in which the insured resides. However, some policies have suit limitation periods in them that can be as short as 1 year. So you might have a claim that's proceeding along. It might involve a lot of paperwork. It might involve a lot of calculations by forensic accountants, and it takes time. And generally, we're trying to stay on top of the suit limitation periods, understanding when they're coming up. In the event it's getting tight, we're asking the insurance carrier to extend the time so that we don't need to file suit and expend money unnecessarily. Previously, the insurance carriers routinely granted extensions of the suit limitation periods. That's not what we're seeing now. That forces you to step up and provide counsel, retain counsel and file suit to toll the statute of limitations. So just another example of how insurance carriers are getting more and more difficult in the claims process given this hard market. The next issue is an interesting issue of related claims. And in E&O and D&O policies, there's a provision in the policies that says that all related claims will be deemed to have happened or been made when the first of them is made. So let's say you have a situation where the first claim of a certain type is made in 2020, and then 2 years later, another claim is made that's virtually identical to it. It's related to it, clearly. And even though that claim is made in 2022, it would relate back and be covered by the 2020 claims made policy. What we've seen is that insurers that are on the 2022 policy, when faced with a related claim that maybe is not perfectly related, it's a bit different, it's against different individuals in the entity or whatever, we'll say, okay, fine, we're not going to treat that as a related claim. We're not going to make you push it back to the 2020 policy, and they'll handle it in the 2022 policy. Now they're stepping up and being hypercritical about its relation back to prior claims. They're going on the internet, Googling the company, trying to find out any other litigation that the company's been involved in so they can relate it back to a prior policy period. Here's the problem with relating it back from a policyholder perspective. And that is that the 2020 policy might have had significant limits that have been exhausted by the payment of other claims in that 2020 policy. Now, if that 2022 claim gets related back to that policy and there's no remaining coverage available, that's a real problem, needless to say. So just another area where this is occurring. And then finally, facts and circumstances reporting. Facts and circumstances reporting, Chelsea, if we can go to the next slide, is a circumstance that permits, doesn't necessarily require, but permits an insured, a policyholder, to, when they are aware that something bad has happened, to report the incident to the insurance carrier, the current insurance carrier, even though under a claims-made policy, no claim has yet been made. Now, that doesn't turn it into a claim. There's no defense obligations or anything like that triggered short of it being a claim. However, the benefit of facts and circumstances reporting is that if you're at the end of the policy period, the sort of reverse of what I was talking about with related claims, where you haven't had any claims reported or paid under the current policy period, and now you're aware of a couple of facts and circumstances that you believe could later give rise to a claim. And realizing that a claims-made policy, once it expires, the coverage is gone. All those limits are gone, and they can't be accessed later, except for a related claim. But anyway, the facts and circumstances reporting permits you to report it now, and if a claim is made later, it will revert back to the policy period within which the claim was reported. So now, there are very stringent requirements for doing that. Generally, the insurers require in the policy that in order to make a facts and circumstances report, you must indicate, the incident, what happened, the potential claimant, whether it's the person who was injured or their family members or whatever, what all of the surrounding circumstances are, the potential damages, things like that. And what we see from time to time is that you'll have insureds that want to report a facts and circumstance, make a facts and circumstances report, and they won't have all of the items as listed in the policy included. And if they make that report without all those items included, what we're seeing now is insurance carriers rejecting them. And here's the problem with a carrier like the 2020 carrier rejecting a facts and circumstances report when the 2021 policy now comes into place. And that is the 2021 policy may have a provision that says if you've reported something to a prior carrier, there will be no coverage for it under this policy. And obviously, if it's rejected by the prior carrier, and now you can't report it to the current carrier, in the event a claim is going to be made against you in this new policy period, you may not have coverage for it. So be very, very cautious and include all the items required in the policy, the 2020 policy, when reporting a facts and circumstances item. So that's what we wanted to talk about today. We're at the 25-minute mark. If anyone has any questions, we're encouraging people to use the chat room. Type it into the chat box. We'd be happy to answer any questions. I guess at this point, Chelsea, we don't have any questions.
We have one question that just came in.
Okay.
Must the carrier specifically invoke the hammer clause, or is it assumed to be invoked for any potential settlements if it is included in the policy?
That's a terrific question. The answer is that the insurance carrier must in fact invoke it. Just because the carrier has the right to invoke it does not mean that it's invoked. And a carrier that wants to invoke the hammer clause will be very clear about it. They will send a letter basically saying, we now deem that the limits under the policy have been amended pursuant to the hammer clause. They don't call it a hammer clause, that's the generic term for it, but they'll give you the section in the policy and say, pursuant to that section, the limits are now reduced to $500,000 if that's what the the settlement demand was that the insurance carrier wanted to accept, and the insured, who has the right to consent to the settlement, rejected.
We have no other questions as of right now, but if anybody has any, please type them into the questions box. And it was requested for us to share our slides, which we will follow up with everyone that attended after this and share all of the slides.
Great. Thank you very much, everybody. We really appreciate you taking the time to join us today. Hopefully you learned something. Reach out to us if you have any further questions or any questions about the program. We're always here to help. Thanks again for attending.
Thanks so much. Have a great day.